Is SCHD the best dividend fund? Or are VIG, VYM and FDVV better? Which dividend fund wins? Hello everyone and welcome back to Markets with Marcus and the long-awaited 7th video in our dividend fund mini-series, where we'll talk about the winning dividend fund and help you decide if it might be the best fit for you as well. Every dividend fund is different, and I'm almost tempted to say there is one for any preference. If you were looking for high dividends, you could find one with an up to 3.3% trailing 12 months distribution yield. But you could also find a dividend fund with a total trailing return of up to 22.76% over the past 3 years. And in between the two, there are other dividend funds that strike their own balance between cash payouts and growth. Because, as many in our Diamond NestEgg community already know, in finance, you can't have both top income and top growth. So, with that in mind, here are the 3 topics that we'll be covering today. 1. What are the top 6 dividend funds that we've discussed in our dividend fund mini-series so far? 2. How do these top 6 dividend funds strike a balance between income and growth? And 3. What's our personal opinion? Please keep in mind that all the numbers in this video are as per July 17, 2026, and that past performance is not indicative of future results or outcomes. Let's get started. What are the top 6 dividend funds that we've discussed in our dividend fund mini-series so far? Let's recap our top 6 dividend funds with a table, as we usually do. Here we have the fund name, the fund ticker, and the total assets in billion. Here we have the expense ratio in percent. Keep in mind though that the expense ratio is already deducted from all the return numbers that we'll be showing you shortly, meaning you don't have to deduct this expense ratio again from those return numbers. Next, we have the date the fund was established. Here we have the 30-day SEC yield and the TTM yield, the trailing 12 months distribution yield per Morningstar. Both distribution yields measure annualized cash distributions, divided by the share price at the end of the last observation period. The main difference is that the 30-day SEC yield, as the name implies, takes the payouts, essentially the dividends, from the last 30 days and annualizes them, while the TTM yield uses the actual distributions over the past 12 months. But distribution yields are only one side of the story. Remember, every dividend fund is still an equity fund at its core and aims to deliver both income from the dividends and growth from the potential appreciation in the stock prices of the underlying portfolio. On the flip side, of course, shareholders remain exposed to the downside risks of all the stocks in the portfolio, and dividends are never guaranteed. So, the trailing total return numbers here track what investors would have made from both dividends and capital gains or losses on an annualized basis had they invested 1, 3, or 10 years ago. If you want a refresher into the strategies, holdings, and dividend history of any of the 6 dividend funds that we are about to cover, please refer back to the first 6 videos of our dividend fund mini-series for a deeper dive. So, starting with the largest dividend fund on our list, Vanguard's Dividend Appreciation ETF, ticker VIG. It has $129.5 billion in assets, charges only 4 basis points in expenses, and recently celebrated its 20th birthday, which makes it the dividend fund with the longest track record on this table. In the next columns, we have the distribution yields and the trailing total returns for VIG. Some of the VIG fans here may recall from our VIG deep dive that one thing that stands out about VIG is its track record of paying stable and predictable dividends since its first full year in 2007. As you can see from this chart, the dividend growth was quite smooth over the period. Only in 2009 and 2013 did we see two small dips, and overall, dividends per share grew by an annualized rate of 8.15% over the period, comfortably more than enough to compensate for inflation and even have a bit left over. We'll be getting back to VIG's distribution yields and trailing returns in the next section of this video, when we walk through these numbers for all top 6 dividend funds together. But feel free to pause the video and take a closer look now if you don't want to wait. The second largest fund on our list is Schwab's US Dividend Equity ETF, ticker SCHD, with $100.8 billion in assets. It charges 6 basis points in expenses and has been on the market for a bit less than 15 years. SCHD's claim to fame, if you want, is that it shows the highest distribution yields on this table at pretty much 3.3% for both the 30-day SEC yield and the TTM yield. Plus, the dividends per share have grown nicely every year since 2012 so far, as you can see here. Like with VIG, we'll drill down into SCHD's distribution yields and trailing total returns shortly. Vanguard's High Dividend Yield ETF, ticker VYM, rounds off the big three with $96.2 billion in assets. Like its Vanguard sibling VIG, VYM charges only 4 basis points in expenses, the lowest ratio on this table, and it has been on the market since 2006. VYM holds more than 600 equity positions, making it easily the most diversified dividend fund by a distance. And again, we'll dive into these return numbers in a moment to discuss how that's worked out for its shareholders in the past. iShares Core Dividend Growth ETF, ticker DGRO, is already much smaller than the first three, with $42.2 billion in assets. It charges 8 basis points for expenses and has been on the market since 2014. DGRO is only one of the 9 dividend funds that BlackRock offers under its iShares brand, but its track record arguably places it right in the statistical middle for all the funds that we've been discussing in our mini-series so far. More about that when we discuss the return profiles later. Capital Group's Dividend Value ETF, ticker CGDV, has already gathered assets of $36.6 billion despite charging 33 basis points in expenses, the most on our list, and being on the market since 2022 only. The secret to CGDV's success, if you want, seems to be that its active management has delivered very competitive total returns so far. For example, over the past 3 years, CGDV was the only dividend fund on our list that had a higher trailing total return than even an index fund like Vanguard's S&P 500 index fund VOO. And yes, VOO is not a dividend fund, but we put it on this table as a reference point for those of you who may be interested in comparing these dividend funds here to a pure play investment in the S&P 500. Rounding out our top 6 dividend funds though, the last one on our list is Fidelity's High Dividend ETF, ticker FDVV, with relatively moderate assets of exactly 10 billion only. It charges 15 basis points in expenses and was established on September 12, 2016. Close enough, we think, to say that it has a track record of 10 years already at the time of this taping. FDVV had a bit of a slow start initially in terms of total assets, but it has picked up growth since then. While it shows neither the highest distribution yields nor the highest trailing total returns on our table, the return numbers indicate that it may have found an attractive balance between income and growth, which leads us directly to the next part of today's discussion. How do these top 6 dividend funds strike a balance between income and growth? On this chart, we show dots for the 6 dividend funds from our table, as well as Vanguard's S&P 500 index fund VOO for comparison purposes. On the x-axis here, we can see the trailing total returns for the last 3 years. The farther right a fund sits, the more investors would have made from both dividend payments and share price gains had they invested 3 years ago. And on the y-axis here, we show the trailing 12 months distribution yield, the actual cash distributions of the fund over the past 12 months, expressed as a percentage of the share price at the end of the last period, as per Morningstar. And the higher up, the higher the trailing 12 months cash distribution yield. In other words, in the perfect dream world, you would want a fund that sits all the way to the right at the very top, meaning very high trailing total returns and a very high trailing 12 months distribution yield. Unfortunately, and as we've discussed in this mini-series, in real life, you can't have both. So every dividend fund tries to strike its own balance between income and growth potential, and is a bit different. You can see this here from how scattered the dots for the funds are. So if you were interested in a dividend fund with the strongest track record for dividend payments, you might start with the fund that's highest up on this chart and take a look at Schwab's SCHD and its 3.3% TTM distribution yield. However, you can also see that SCHD is towards the left end of the chart, meaning that if we include share price gains as well, its trailing total returns of 14.64% over the past 3 years are weaker than for all other funds here, except VYM. Fidelity's FDVV strikes a somewhat different balance. Its distribution yield of 2.87% is a bit lower than SCHD's, but its total returns of 19.05% are higher. In fact, FDVV is the only fund here in the top right quadrant, meaning it has both a higher distribution yield and higher total trailing returns than the average of our 6 funds. Vanguard's VYM is the third fund with an above average distribution yield of 2.3%. Its total trailing return of 11.72% is the lowest of our funds though. That said, VYM is the most diversified fund if you measure it by the number of the 600 equity positions it holds, more than any other of our funds here, as we mentioned already. Now, it may be less common for dividend funds, but some investors might also start their research from the right-hand side of the chart, where the highest trailing total returns are. And here we see, perhaps a bit surprisingly, Capital Group's CGDV as a real outlier. With an annualized total return of 22.76% over the past 3 years, it outperformed even an S&P 500 index fund like Vanguard's VOO, which only managed 19.71%. When I see this, I sometimes wonder whether CGDV is really run as a dividend fund, or whether we shouldn't really consider it more like an actively managed alternative to S&P 500 index funds. In fact, even CGDV's distribution yield of only 1.19% is very low for a fund with dividend in its name, and not substantially higher than what an investor would have got from VOO's 1.07%. Having already discussed FDVV and its balanced track record between income and growth, this leaves us with 2 funds that have not outperformed the averages on this chart, either with their distribution yields or with their total trailing returns. BlackRock's iShares DGRO basically looks like a safe pair of hands. Its distribution yield of 1.95%, as well as its trailing total return of 16.82%, mirror almost exactly the averages on the chart. And as for Vanguard's VIG, neither its distribution yield of 1.51% nor its trailing total returns of 15.33% are outstanding. But it has a strong track record of growing its dividend per share at an annualized rate of 8.15% since 2007, as I touched upon before. That said, VIG has one of the lowest expense ratios on our table, and it remains the largest dividend fund on the market. So I suppose some see it as a safe default choice if neither income nor growth are priorities, and you have no strong opinion about which dividend fund to choose. Which leads us to the next part of today's discussion. What's our personal opinion? Everyone's financial journey is different, and so are the dividend funds that we discussed in this mini-series. In the end, you need to choose the fund that's right for you, while keeping in mind that all the numbers that we've discussed are based on the historical performance of these funds, and that the future may look completely different. We personally don't own any dividend funds currently. As I've said before, we are still very much in the growth phase, with a sufficiently long time horizon that should allow us to ride out any volatility and setbacks in our S&P 500 funds and similar investments. And when it comes to guaranteed income, we generally prefer annuities, treasuries, and similarly safe bonds. Remember that the base part of a portfolio should mainly be oriented towards safe, stable, and predictable income that lasts a lifetime, and no dividend fund is built for that. But that's us at our current stage in life. When the time comes for us to retire, we could see ourselves revisiting dividend funds under a different lens. We could see a place for dividend funds in the boost part of a portfolio if you can agree with the following statements. 1. You want to build an extra income stream from the equity part of your portfolio that, while not guaranteed, has a strong track record of growing over time. As you can see on this chart, all top 6 dividend funds that we've covered in this mini-series have generally grown their dividends per share over time, despite some volatility and setbacks that were more pronounced for some funds than for others. 2. You are looking for real assets that may help to protect both your principal and income against inflation. Equity funds are real assets that have provided good inflation protection in the past, and dividend funds with a focus on sustainable and growing dividends may help with protecting a part of your income stream as well in the long run. 3. You are looking for a balanced and potentially even a bit defensive fund that might diversify the equity part of your portfolio. If that's the case, you want to look for a dividend fund whose investment approach, industry mix, and track record might complement your portfolio. And as we've seen, there are several good options to potentially choose from. You might also appreciate the dividend stream as another potentially stabilizing factor. On the other hand, you should probably not consider an investment in dividend funds if you agree with even one of these statements. 1. You want to build a lifelong and guaranteed income stream for the base part of your retirement portfolio. As I said before, only annuities and/or treasuries and similarly safe bonds can give you that. Dividends are never guaranteed. 2. You fear a potential market correction or even crash and are not looking to add to your equity exposure. Remember, all dividend funds are equity funds, and shareholders remain exposed to the downside risks of all the stocks in the portfolio. And the next few years may look different from the strong run we've seen recently in the market. 3. You are skeptical about dividend funds in general and feel that they are neither here nor there. Remember, all dividend funds need to accept certain trade-offs because they try to combine income with growth. And every dividend fund is different. Some investors may prefer what the industry calls a barbell approach of simple index funds for growth and annuities and/or treasuries and other bonds for income. Of course, that's our perspective only. Yours may be completely different. Plus, as we often say, it's rarely all or nothing in money and investing. Dividend funds may still play a constructive role in an overall well-diversified portfolio. So I hope you enjoyed the last part of our dividend fund mini-series. And if at this point you're interested in joining our daily member conversations and regular deep dives into other potentially higher yielding investment opportunities, come on over and check out our VIP investment club. Visit our website at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button to learn more and join us today. We've also linked everything below this video for your convenience. And drop a comment below and let our Diamond NestEgg community know. What are you buying right now and what ETFs would you be interested in learning more about? Thanks for watching and I'll be back.